To build anything that truly lasts, it takes time.
Hello and welcome to the Money Show, where your financial journey becomes clearer, smarter and more empowering every single week. I'm Kavita Thaplial, and whether you are just starting out with your first budget, navigating the world of investments or planning for that dream retirement, this is the place to be. Here we break down complex money topics into simple, actionable steps, no jargon, no fluff, just real advice you can use to build wealth, avoid debt, and live the life you want. From saving hacks and credit tips to insider insights on stocks, crypto, and everything in between, we are diving deep, asking the tough questions, and bringing experts right to your ears. So get ready to take control of your financial future, boost your confidence, and turn money stress into money success, because you're on the Money Show. Your money matters, and we are here to help you make every money count. So this show is also a personal finance show where we answer your portfolio queries. So just in case you want to send across your questions, you can do that on our WhatsApp number, which is 865-797-4571. We also have an email ID where you can send across your questions. The ID is themoneyshow@etnow.tv. All right, so let's begin. And in a world that's rapidly shifting economically, politically, and even socially, the dream of studying abroad has never been more desirable or daunting. With global uncertainties looming from visa restrictions to financial volatility, students and parents are asking the tough question: is it still worth it? Today, we break down the uncertainties around education abroad, not just from a financial lens, but from a career point of view as well. We'll be joined by our experts who will answer all your questions related to education abroad. Joining us to decode the money puzzle is Ankit Bagadia, representing Bank Bazaar, with insights on education loans, repayment strategies, and what you need to keep in mind before signing on the dotted line. And on the career front, we'll be joined by Adarsh Khandelwal, a seasoned career coach, to guide us through what courses are in demand, where opportunities are shifting, and how students can stay ahead of the curve even when the world feels a bit uncertain. Okay, so let's begin. And I don't think I have Aditya yet on the show, but then Ankit, hi, good evening and welcome to the show. Let's begin. Let's start with the basics. If someone is considering an education loan for studying abroad, what's the first step according to you?
Thank you so much, Kavita, for having me on the show today. Always a pleasure to discuss something as life-changing as education, especially when it takes you across borders and beyond boundaries. So, yes, as you rightly, started the show with, education is the best investment one makes, either on themselves or their family. It is said degrees fade on paper, but education pays lifelong dividends. And so, an education loan is not certainly a debt. It's a delayed down payment on your dreams. I always say that you're not borrowing money, you're borrowing momentum, right? So with that thought, now practically speaking, which you meant about studying abroad, it's not just an academic decision. It's a high stakes financial investment. So how can one look at education loan? One should always start with a cost estimate, which includes your tuition fees, living expenses, travel, visa, health insurance. All those costs are there, and forex buffer as well. So an estimated of around 30 to 80 lakhs is what a loan would cost, education loan would cost for an education abroad. Now, this loan approval is often linked to admission offer letters, and you need to make sure you apply to universities and have tentative offers in place before loan applications. Understand the loan eligibility, check if your course and university are on the lender's approved list, compare between secured and unsecured loans as well. So, if you have a property to pledge, you may qualify for better, lower rates and, better lending terms, basically. And you should always talk to multiple lenders, including banks, NBFCs, fintechs, and ask for sanction letters in advance. It helps with visa and planning. So overall, it's a very detailed process, and it's a good investment to start with. And we can take up the questions one by one. Kavita, over to you.
All right. So I don't think I'll be getting Adarsh on the show, but then I was just wondering if you could also, act as a career coach on the show today. I mean, just try, Ankit. I really want to understand if one really wants to, consider studying abroad in this current global climate. Is it recommendable? Would you really suggest someone consider going abroad from a vantage point of view as well? A lot of
Sure.
uncertainties on different fronts looming up. How do you look at it?
Absolutely, and this is spot on, Kavita. So in today's scenario, where we see challenges in student visa, right from the visa level to universities to the tussle that is going on between Harvard versus U.S. government, so countries and the job scenarios, the opportunities also in these countries, these are completely agnostic, and we do not have any control on these macro parameters. But when you really ask the question whether one should really go for education abroad, the simple answer would be to assess yourself in terms of the opportunities that are available where you're planning to go, to assess yourself in terms of what career path are you choosing yourself. And in terms of today's scenario, see, these scenarios and these situations are temporarily. They will come and go. Presidents change, governments change. So this is a long-term commitment for yourself. So I believe any career should be drawn in terms of that long-term aspect that you really want out of your education. And as I mentioned, education is something which pays longer dividends, much better than any other investments in the markets as well. So that's my take on it. I believe one should always invest either abroad or domestically. They should always look out, plan better, plan the ROI. And today's students are so smart. They are not planning just a statement of purpose saying that they want to go abroad. They're planning return on investment. So that's how you one should look at it. So many countries might have and difficulties in today's scenario, but that said, there are countries which are open for Indian students as well. So, for example, New Zealand. New Zealand is right now looking at a 30% jump in the student intake from India, given the situation in Canada, US, what our students are facing. So that's just an example, Kavita, for the audience.
Now, I really want to understand now, can you break down the key terms students should look at?
Mhm.
Education loan. Having said that, it depends on your area and the kind of amount that you're looking at. A lot of other aspects in terms of your collateral, etc. But then, what should be the parameters to decide on a loan? Interest rate, repayment schedules, collateral requirements. How can one look at it? If you can just, explain this in simple language.
Sure. So let's make it very simple for the audience. There are two types of education loans available in the market. One is secured loan, and the other is unsecured loan. Secured loan, obviously, by the name itself, has a collateral attached to it. The other has no collateral. And the basic difference is that in a secured loan, once you have a collateral, the interest rates would be lower. The loan tenure and loan amount would be higher because you have a collateral attached to it, which is a safety for the banks. Unsecured loans, on the other side, doesn't have a safety like a collateral, but there the interest rates might be a little bit higher. But over there, you need a strong co-applicant profile, a co-borrower profile, which can help you get the better interest rates and better lending terms. Now, repayment, when you see an education loan is as similar to as a personal loan, but in education loan, one stark difference is the moratorium period, which is nothing but the course duration plus a certain grace period of 6 to 12 months, wherein the student or the family is not required to pay any EMIs. This is called the moratorium period. The EMI payment only starts after the completion of course plus 6 months or 12 months, depending on the lender policy. Now, why is it so? This is because it gives students enough time to stabilize, get a job in that particular country, stabilize, absorb that particular environment, and then start EMI once they are comfortable in their jobs. The second aspect is what is the kind of interest that the banks is charging, banks or NBFCs or lender which you're taking loan from charges you. It's if it is a simple interest, then the bank expects you to pay a certain interest component, only the interest component right from day one, even before the visa has arrived. So that is called simple interest. But that is generally mostly paid by the family member or the earning co-applicant, which has applied together. However, most loans which we see nowadays are based on compound interest. Now, what happens is in this, there is no payment required to be done until the end of the course plus the grace period. But the interest keeps on generating and accruing on that particular loan amount and gets added to the principal at the end of this moratorium period. So, for example, I'll just take an example. If you've taken a loan of 40 lakh from the lender, and the interest for the period of course duration, which is the moratorium period, is say, for example, 5 lakhs. The principal then becomes 45 lakhs at the end of moratorium period. And then the EMI starts from that day. So the student has to pay an EMI on the 45 lakh loan whenever he's starting the EMI. So that's the moratorium period, which helps the students to get a better, to stay there, get a better job, and then start paying EMIs. So depending on lenders' policies, simple or compound interest accrues, moratorium periods, lending terms, etc., can be defined. So these are the repayment nitty-gritties that needs to be looked at when you're taking an education loan. Kavita.
Ankit, can you also give us a ballpark figure in terms of what students can expect to spend, and not just the tuition cost? I'm talking about cost of living, your insurance, and other expenses.
Right. So when we look at moving abroad, the costs include not just tuition fees but also health insurance costs, which are mandatory, visa costs. So visa cost can range today from 5,000 onwards, and it can even go up to a lakh rupee. Australian visas, student visas are generally costly. Living costs in terms of hostel, food, local transport, etc., can again cost you in the entire duration, course duration. If it's a 2 year course duration, you might end up around spending around 80 lakhs to 1 crore, depending on the country, on the cost of living, and on the cost of tuition fee as well. So if it is a course which is charging you 40 to 50 lakhs, you might end up spending around 70 to 80 lakhs in the entire duration. So that's the rough estimate, but you should always consider inflation, which is also increasing year on year. And you should also consider foreign exchange fluctuation, which is the forex risk that a student carries. Because if there are changes in the foreign currency, which we have seen that every year the foreign currency appreciates by 3.5%, and the rupee value depreciates. So that's an approximate number. So again, 8 to 10% is the forex buffer that a student needs to carry in mind and plan accordingly. When they're taking up the loan.
Getting the conversation back on the interest rate aspect, how do interest rate vary for different countries or courses, if at all?
Yes. So this is an interesting question. So if a student has an admit from Ivy League colleges like Brown University, Cornell, Dartmouth, or Harvard, Pennsylvania, Yale, all these colleges. So these are like top of the cream colleges, gold standard of education. University and banks and lenders really want students to get into these top universities, top ranking universities, because there they have they have that insight that if you are from this particular college, you will definitely get a good job, a better paying job, a better paying income, and that will be a low risk for the lender as well. But however, if your college is a low ranking college, then the lenders obviously are a little concerned, and they might look at additional parameters like how strong is the co-applicant profile, or what they might increase the interest rate, etc. So choice of college is really something which can influence your interest rate. Apart from that, collateral can influence your interest rate. If you have a real estate backed up on that particular loan, then you might get a lower interest rate. However, if you do not have any collateral, so that again will influence and improve, increase your interest rate. Third aspect which increases or influences your interest rate is the co-borrower profile. If your parent is a salaried professional, category A company whose creditworthiness and CIBIL scores are really excellent, so they are eligible for a seriously good amount of loan, which can exceed 40, 50 lakhs easily without any collateral. However, if the creditworthiness of the co-borrower is not that great, then interest rates again might be much more than what you end up paying. So higher interest rates are in those scenarios where you do not fit into all these three criteria, which is either a better college, or having a collateral, or a good co-borrower or co-applicant profile.
Also, Ankit, are there any smart hacks or hidden benefits in loan products that students or parents often miss?
Right. So the best hack is to understand your capacity to pay the interest payment right from the day one. So what happens in education loan is people generally go for compounding of interest, and that interest becomes your principal at a later point in time after the moratorium period ends. And what happens is you end up paying interest on the entire interest that was generated in the course duration plus the grace period. So what smart people or smart students do is they, try to pay the interest, monthly interest, right from day one itself. What happens is in that, course of generation, the interest that you end up paying on the interest generated is not carry forwarded. So in very simple terms, if you've taken a 40 lakhs of loan and the interest amount is 5 lakhs, in a compounded interest, it will get added to your principal, and you end up paying interest on 45 lakhs. Whereas in a simple interest, you just end up paying, interest on 40 lakhs. So that is one of the most and unique and best hack that a parent and a student can, go ahead with. Only if their capacity is there to, pay the interest upfront. So it's not an EMI. EMI might be 30,000, 40,000 a month, but the interest component would be 8, 10,000, 12,000 a month. So that's one of the best things. And the second thing which everybody should look at is they should keep a buffer at their end as well. So if the education loan is being taken for the entire cost of living, cost of tuition fees, etc., but they should always be prepared and have additional credit capability for bearing any emergencies, for bearing any forex buffer risks, for taking up any additional ad hoc travel or transport cost, which will not be borne by the banks. So you should always have surplus liquidity planned in a way which better manages your stay abroad. These are, the top two hacks, Kavita.
Public sector banks or private lenders or NBFCs, what should one consider before choosing the right kind of lender for them?
Right. So this is an interesting one. So people generally think that public sector banks being they give lesser interest rates and hence they are the best lenders. However, this completely depends on what kind of loan term or lenders are you chasing, because of you don't need to chase just the lowest interest rate. You need to chase. You also worry about which bank is offering you the fastest processing time. Are there any hidden charges, processing fees? What is the kind of terms and conditions? Is the moratorium period good enough for you? So if it's a 4-year course, STEM courses, plus, what is the kind of moratorium? Because on those courses, you might not be able to get a job immediately out of the campus. And, you might need an extended time duration. How flexible is the bank on, repayment terms when it comes to, is it flexible on prepayment without any charges? When you have a job, you can probably prepay in advance and save on interest component. So when you compare a public sector bank, they are very rigid. They have a standard set of policies and policies to follow, and terms and conditions. But when it comes to private sector bank, you get faster turnaround times, you get better loan terms and conditions. And now, when it comes to NBFCs, in fact, you might even get collateral free loans, which are not available in the banks completely. So because the loan amount would be higher, loan tenure would be higher, the banks are not able to give at a certain amount without any collateral. But NBFCs and fintech platforms, which compare these loans and estimates your EMIs, etc., they might be able to give you better loan tenures, loan amounts. So it completely depends on your situation as to what you're really looking for, which college you're really aiming at, what's the kind of scenario, are you with collateral, without collateral, co-borrower profile. You need to compare between across all these three categories before deciding on the final one. But one takeaway, which I can really share is don't just go for the lowest interest rates. Go for the a financial partner because it is a long-term loan and you might need flexibility even abroad.
One last question before we wrap up this particular segment, Ankit. With rising currency fluctuation, do you advise taking
Yeah.
loans in INR or foreign currencies, or how can just one mitigate the volatility that one might see in currency?
Right. So this is a very interesting debate which students have and a concern which students have generally. And what happens is when tuition fees is disbursed, it is directly disbursed into the college account and where the course is being done. At times, what happens is between the sanction and the disbursement, there might be a time period where the foreign exchange has already fluctuated and there's a risk to that the course fees has increased by a certain percentage. So to cover that risk, what generally NBFCs do is they provide you a cover of a blanket cover which is certain more than your required tuition fees and living costs. So there are certain NBFCs and fintech platforms which cover you beyond the tuition fees. So if the tuition fees is stated as 30 lakhs in the offer letter, in the admit letter, these banks will absolutely cover you for the forex risk, which is in terms of any other currency. And you need not worry about that. But however, there are some banks which might not really be able to cover that kind of a risk as well. And any gap and any fluctuation needs to be covered by the student then. So you need to really assess those. And this is a very important point that you brought up. You need to assess that kind of terms and conditions in the loan from the lender as well.
All right. I think with that, it's a wrap. Thank you so much, Ankit, for being on the show and helping our viewers, with every step of planning to take an education loan. Thank you.
Thank you.